There is an account in the US tax code that is tax-free when you put money in, tax-free while it grows, and tax-free when you take it out. Triple tax-free. No 401k does this. No Roth IRA does this. No brokerage account does this. Nothing else in America gives you all three. It is called an HSA. The 2026 limit is $4,400 a year. The problem? Most Americans either don't have one or have one and are treating it like a checking account when it should be treated like a retirement account. In the next 10 minutes, I will show you how $4,400 a year grows into $196,000 tax-free. Why this account beats every other account in America on taxes. And the one thing that happens at age 65 that almost nobody talks about. Every investment account in America gives you one or two of these benefits. The HSA gives you all three. Let me compare them. A traditional 401k or IRA, tax-free going in because your contributions are pre-tax. Tax-free while it grows because earnings are tax-deferred, but taxed coming out. When you withdraw in retirement, you pay income tax, 2 out of 3. A Roth IRA, taxed going in because you contribute after-tax dollars. Tax-free while it grows. Tax-free coming out. Also, 2 out of 3. An HSA, tax-free going in. Your contributions are pre-tax or tax-deductible. Tax-free while it grows. Earnings and investment gains are not taxed. And tax-free coming out as long as withdrawals are for qualified medical expenses. 3 out of 3. And if you contribute through payroll deductions at your employer, you also avoid Social Security and Medicare taxes on those dollars. That is a benefit that even a 401k and Roth IRA do not provide. The HSA is not just triple tax-free. Through payroll, it is effectively quadruple tax-free. Let me show you what this looks like in real dollars. Let us say you earn $65,000. You are in the 22% federal tax bracket. Your state tax rate is 5%. And FICA taxes at another 7.65%. If you contribute the maximum for individual coverage in 2026, $4,400 through payroll deductions, you save 22% in federal tax. That is $968. You save 5% in state tax. That is $220. You save 7.65% in FICA. That is $336. The total tax savings in 1 year, approximately $1,524 on $4,400 contributed. That is a 35% immediate return on your money, just from tax savings, before the money even grows, before you even invested. 35% return, day one. And the money is still yours, sitting in your HSA, growing. Now, here is the mistake. Most people who have an HSA use it like a checking account. They contribute money. They spend it on a doctor visit or a prescription. The balance goes back to zero. That is not wrong. But it is like buying a Ferrari and only driving it to the mailbox. You are using 1% of its capability. The real power of an HSA is that you can invest the money inside it. Most HSA providers let you invest your balance in mutual funds, index funds, ETFs, just like a 401k or IRA. And those investment gains grow tax-free. If you invest your $4,400 annual HSA contribution in a total stock market index fund at 7% average return for 20 years, your HSA balance grows to approximately $190,000. $6,000. Tax-free. You contributed about $88,000 over 20 years. The other $108,000 came from investment growth, and none of it is taxed. The average HSA balance at the end of 2024 was only $5,000. Most people are spending it instead of investing it. Most people have no idea the money can grow. Here is the advanced strategy that financial planners use. Pay medical expenses out of pocket, not from your HSA. Keep receipts. Let the HSA money grow. Invest it. There is no time limit on HSA reimbursements. You can reimburse yourself for a medical expense from 10 years ago, as long as you have the receipt. So your strategy is pay out of pocket today. Keep the receipt in a folder. Let the HSA money compound for decades. Then, whenever you want, pull out the money tax-free by matching it against all those old receipts. You get tax-free growth for as long as you want and tax-free withdrawal whenever you need it. It is a stealth retirement account hiding inside a health account. No other account in America lets you do this. Now, the age 65 reveal. At age 65, the HSA transforms. Before 65, if you withdraw money for non-medical expenses, you pay income tax plus a 20% penalty. After 65, the 20% penalty disappears. You can withdraw money for any reason, medical or not, groceries, travel, mortgage, anything. If it is for medical expenses, still completely tax-free. If it is for non-medical expenses, you pay regular income tax, which is exactly the same as a traditional 401k or IRA. So after 65, your HSA functions identically to a 401k, but with the additional benefit that medical withdrawals are completely tax-free. And considering that the average retired couple spends approximately $315,000 on healthcare in retirement. Having an HSA filled with tax-free money for exactly that purpose is one of the smartest financial moves an American can make. At 65, this is not just a health account. It is a health account, plus a retirement account, plus a tax shelter, all in one. In 2026, something changed. The One Big Beautiful Bill Act expanded HSA eligibility. Previously, only people enrolled in specific high-deductible health plans were eligible. Starting in 2026, all bronze and catastrophic health plans on the marketplace now qualify for HSA contributions. This means millions of additional Americans who buy insurance through healthcare.gov are now eligible for the first time. Here are the 2026 contribution limits. For individual coverage, $4,400 per year. For family coverage, $8,750 per year. If you're 55 or older, you can add an extra $1,000. To qualify, you need a high deductible health plan with a minimum deductible of $1,700 for individual coverage, or $3,400 for family coverage. You cannot have other non-HDHP coverage. You cannot be enrolled in Medicare, and you cannot be claimed as a dependent on someone else's taxes. If you meet these requirements, you are eligible, And if you are not using it, you are giving the IRS money. You do not have to. Here is what to do right now. Step 1. Check if your health plan is HSA eligible. If you have an OCHI, HP through your employer or the marketplace, you qualify. Ask HR or check your plan documents. Step 2. Open an HSA. Many employers offer one through a provider like Fidelity, Health Equity, or Optum Bank. If your employer does not offer one, you can open your own at Fidelity or Lively. Step 3. Contribute through payroll, if possible. This gives you the FISA tax savings you do not get with direct contributions. Set it up to contribute evenly throughout the year. Step 4. Choose investments. Once your balance exceeds the minimum threshold, usually $1,000 to $2,000, invest the rest in a low-cost total stock market index fund. The same funds you use in your Roth IRA or 401k. Step 5. Pay medical expenses out of pocket when possible. Save receipts digitally, in a folder on your phone, or in a Google Drive. Let the HSA balance grow and compound for decades. And step 6. After 65, reimburse yourself from decades of saved receipts. Or use the money for any expense you want. One more thing. Do not confuse an HSA with an FSA. An FSA is a flexible spending account. It is offered through many employers. And it has one devastating problem. Use it or lose it. If you do not spend your FSA balance by the end of the year, you lose the money. Gone. An HSA has no such rule. Your money rolls over, year after year, forever. It stays yours. Even if you change employers, even if you change health plans, even if you become ineligible to contribute, the money is yours permanently. An FSA is a spending tool. An HSA is a wealth building tool. They sound similar. They are completely different. The HSA is the most underused account in America. Tax-free in, tax-free growth, tax-free out. Invest it. Let it compound. Save receipts. At 65, it becomes the most flexible account you own. And in 2026, more Americans are eligible than ever before. If you have an HDHP and you do not have an HSA, you are giving the IRS your money for free. Do you have an HSA? Drop one below. Have one if you already have an HSA. Spending it if you have one, but use it like a checking account. Investing it if you are letting it grow. No idea if you have never heard of this account. Or not eligible if your plan does not qualify. If you want to understand tax brackets better, my complete tax bracket guide is on your screen right now. And if you want to set up a 401k or Roth IRA alongside your HSA, those videos are there too. Subscribe to Wealth Storyline. Every week, we break down the money systems most Americans were never taught. See you there. This video is for educational and entertainment purposes only and should not be considered tax or financial advice. Consult a qualified professional for your specific situation.